Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
Hey everyone, and welcome back to The Deep Dive. If your small business is anything like mine, you're probably already starting to wonder what 2025 has in store, especially when it comes to taxes.
Yeah, you're not alone there. A lot of the sources we're looking at are calling this coming year a year for action when it comes to tax policy in Washington. And a big part of that is this pretty massive tax bill that's on the horizon. It all kind of boils down to this. A lot of the provisions from the 2017 Tax Cuts and Jobs Act, that's the TCJA, are set to expire at the end of 2025.
And for us small business owners, that's not just some abstract political thing. If Congress doesn't step in and make some decisions, we could be looking at automatic tax increases. Ouch. So we've been doing a deep dive into this 2025 tax policy outlook, trying to really unpack what it all means for folks like us.
Right. It's a lot to sift through.
It really is. So today our mission is to pull out those key tax planning issues that you need to be thinking about right now. And crucially, we want to explore some ways you might be able to, navigate this whole evolving tax landscape.
Absolutely. And I think one of the most interesting things to consider here is the political landscape. We've got a new Trump administration coming in, and Republicans have control of both the House and the Senate. So that could make it a lot easier to pass tax legislation, potentially through this process called budget reconciliation. It's basically a way to get things through the Senate with a simple majority vote.
Okay. So that's interesting. But the report does mention that the Republican majority in the House is, it's thinner than it was back in 2017 when the TCJA was first passed.
It is. So that's something to keep in mind.
Definitely. Okay, so given all of this, what are the big questions that small business owners should be asking themselves as they look ahead to 2025 and beyond?
Well, I think a really important starting point is to ask yourself, will Congress decide to extend some of those key TCJA provisions that are scheduled to sunset? What about new tax changes? What's on the table? And how could things like the federal debt and the possibility of government shutdowns, how could those factors influence tax policy decisions?
Yeah.
And then on a more practical level, we've got to think about, could there be changes to business tax rates? What about those deductions that we all rely on? And we can't forget about potential shifts in international tax rules and trade policies.
Right. So many moving parts. Okay, let's start by digging into those expiring TCJA provisions, especially the ones that are specific to businesses. What should a small business owner be paying close attention to?
Sure. So as we approach the end of 2025, a handful of international tax rules are set to change. Those include the Global Intangible Low-Taxed Income Regime, we call that GILTI for short. And then there's the Base Erosion and Anti-Abuse Tax, which is known as BEAT. And we also have the deduction for Foreign-Derived Intangible Income, that's FDII. And lastly, the look-through treatment for certain Controlled Foreign Corporation Income, or CFC income, is also set to expire.
Okay, I gotta admit, those acronyms are a bit much, but for a small business owner who might be doing some business internationally, maybe they're exporting some goods or they have a small office overseas, why should they care about all of this?
Yeah, it can seem pretty technical, but it's important. Even if your small business only has a limited amount of international activity, these rules can really impact how your income from those activities gets taxed. Take GILTI, for example. It's basically a rule that's designed to make sure that certain types of foreign income are taxed at a minimum level. So imagine you're a small tech company with a subsidiary over in Ireland. Well, the potential changes to GILTI could have a big impact on your effective tax rate on the profits that you're making overseas. You might have to rethink your pricing strategies or even consider restructuring your international operations.
Right.
And then there's BEAT. That one's generally more targeted at those really big corporations, trying to prevent them from using, really aggressive strategies to lower their U.S. taxes by shifting profits to foreign affiliates. But depending on how your business is structured, it's still worth having on your radar. FDII, on the other hand, gives you a tax break for income that you earn from exporting goods or providing services to customers outside the U.S. So if that goes away, it could increase your tax burden on those specific activities. And finally, the look-through rule, if that ends, it could change how the IRS treats income from your CFC, which is essentially a foreign corporation that you control.
Okay. So I'm starting to see why even a smaller business with a bit of international activity needs to pay attention. So much complexity.
There is. And what makes it even harder for planning purposes is that we don't know for sure whether Congress will extend these provisions, modify them, or just let them expire.
Okay, so let's shift gears a bit and talk about President Trump's tax proposals. The Outlook highlighted some pretty significant ideas that could potentially affect businesses.
Yeah, there are a few key proposals that are being floated around. One of the big ones is this idea of lowering the corporate income tax rate to 15%. But here's the catch. It seems like they want to target that lower rate, specifically at companies that are manufacturing goods here in the United States. And they're actually looking at the old Section 199 domestic manufacturing deduction, which was repealed, as a possible model for how to structure this new incentive.
So it's not just a straight up corporate tax cut for everyone, but it's tied to encouraging domestic manufacturing.
It seems that way.
Interesting. Okay, so what else is being proposed that could affect small businesses more broadly?
Well, there's talk of bringing back 100% bonus depreciation under Section 168K. Basically, that means that businesses could immediately deduct the full cost of certain new or used equipment and other qualifying property in the year that they buy it and start using it. So let's say you're planning to invest in some new machinery. Well, bonus depreciation would give you a really nice upfront tax benefit.
I like the sound of that.
Yeah, it can be pretty impactful. And another proposal that's gaining some traction is restoring Section 174 expensing. This would allow businesses to immediately deduct their expenses for research and development activities that are based in the U.S. Right now, those deductions have to be spread out over several years. So going back to immediate expensing could be a huge boost, especially for businesses that are heavily invested in R&D. It's worth noting that there was actually an attempt last year to reinstate both of these provisions retroactively. There was a bill, H.R. 7024, but it ended up stalling in the Senate.
Ah, okay. So bonus depreciation and Section 174 expensing both sound like they could have a more immediate and direct impact on a lot of small businesses,
Absolutely.
especially those that are, really looking to invest and grow their operations. Can you talk a little bit more about how those provisions could help businesses?
Sure. So with bonus depreciation, you're basically getting a much bigger tax break up front when you invest in things like equipment. That can really free up cash flow in the short term, which is huge for a lot of small businesses. And when it comes to Section 174 expensing, the ability to write off those R&D costs immediately can really encourage innovation. Instead of waiting years to recoup those costs through deductions, you can deduct them right away, which lowers your current tax liability and can potentially free up more capital for further investment. These are definitely provisions that can incentivize growth.
Right. So it's all about, making those investments now and reaping the tax benefits sooner rather than later.
Exactly.
Okay. But we also have to remember that tax changes don't happen in a vacuum. The Outlook also talked about these potential revenue-raising offsets. Essentially, if some taxes are going down, the government's probably going to look for ways to bring in more revenue somewhere else. So what could that look like for businesses?
That's a crucial point. And one of the things that the Outlook mentions is the possibility of limiting the federal deduction for state and local taxes, that's LSLT, for C corporations. Now, under current law, C corporations can deduct those state and local taxes on their federal returns. But if Congress decides to limit that deduction, it could directly increase the overall tax burden for those businesses, especially if they're located in a state with high state and local taxes. The Outlook actually includes a helpful figure that shows the current state corporate tax rates across the country, and it really highlights how the impact of a SALT deduction limitation could vary widely depending on where your business is located.
Okay, so even if the federal corporate tax rate goes down, like in that proposal we talked about, losing some or all of the SALT deduction could wipe out those savings, at least for some companies, depending on where they are and what their state tax burden looks like.
Exactly, and it's a good reminder that tax planning is about looking at the big picture. It's not just about one rate or one deduction in isolation.
For sure. Now, the Outlook also briefly mentions some other potential revenue raisers.
They do. They talk about the possibility of, broader limitations on the corporate deduction for all state and local business taxes. And they also touch on the idea of targeting those pass-through entity tax regimes that a lot of states have implemented. Those state-level regimes are designed to help the owners of pass-through businesses, like partnerships and S corporations, avoid those federal SALT deduction limitations that apply to individuals. So it'll be interesting to see what happens there.
So it's a pretty complex web of interconnected things to keep track of.
It is.
It sounds like even though an increase in the main federal corporate income tax rate, which is at 21% right now, is seen as unlikely, some of these other adjustments could still have a negative effect on domestic investment.
Yeah, I think that's a really important takeaway. It's not always about the big headline rate.
Right. Okay, let's shift gears again and talk about global tax policy changes, specifically this thing called the OECD's Pillar 2 initiative. This might sound like something that only affects those giant multinational corporations, but even smaller businesses with an international footprint need to understand what this is all about.
Absolutely. And you're right, Pillar 2 can seem pretty intimidating. But it's essentially a global effort to set a minimum corporate tax rate of 15%. And a lot of developed economies around the world have already adopted it, or they're in the process of doing so. Now, while it's not expected that the U.S. Congress will actually implement Pillar 2 here domestically, it's super important for U.S. multinational companies, and that includes smaller businesses with operations in other countries, to understand that they can still be subject to these rules in those foreign jurisdictions.
Oh, okay. So even if the U.S. doesn't adopt Pillar 2, if my business has a small subsidiary in, let's say, Germany, and their effective tax rate there falls below that 15% threshold, we could still be on the hook for a top-up tax in Germany.
Yeah, that's exactly how it could work. The Outlook breaks down some of the key components of Pillar 2, things like the Income Inclusion Rule, or IIR, the Qualified Domestic Minimum Top-Up Tax, or QDMTT, and the Undertaxed Profits Rule, or UTPR. I know it's a lot of acronyms. But basically, these rules all work together to try to make sure that large multinational groups are paying at least that 15% tax rate on their profits, no matter where in the world those profits are earned. So in your example with the German subsidiary, if their effective tax rate in Germany is below 15%, you could face an additional tax liability there to bring it up to that minimum. And on top of that, there are these significant new reporting requirements that come with Pillar 2 that you would have to deal with.
Wow. So even if you're a small business, if you're operating internationally, things can get really complicated really quickly. Now, I do remember the Outlook mentioning something about a safe harbor, at least temporarily.
You're right. There is this transitional UTPR safe harbor that applies to businesses based in countries that have a corporate tax rate of at least 20%, including any subnational taxes. And generally, the U.S. meets that threshold. So that safe harbor could provide some relief from the UTPR, at least for now. But, and this is important, it's set to expire at the end of 2025. So businesses with international operations really need to stay on top of how this develops and what the implications are going to be down the road.
So much to think about. Okay, let's move on to something that can directly hit a small business's bottom line: trade policy and tariffs. President Trump has talked about some pretty big tariff increases, hasn't he?
He has, and these are pretty substantial increases. For imports from China, we're looking at potentially another 10% on top of existing tariffs, or even a flat 60% across the board. On goods coming in from Mexico and Canada, the proposal is a 25% tariff on everything, and then even higher tariffs, like 100% to 200% on vehicles specifically from Mexico. And for the rest of the world, we could see tariffs ranging from 10% to 20%. The Outlook has some really good figures that illustrate just how big these changes could be and what kind of impact they could have on the value of imports and the amount of duties that businesses would have to pay.
Yeah, that's a pretty big potential cost increase for a lot of businesses.
It is.
What does this mean for a small business that imports goods, even if they're currently coming in duty-free under existing free trade agreements like USMCA?
That's a great question. And it's a really important point for small business owners to understand. Even if you're currently benefiting from duty-free treatment under agreements like USMCA, these proposed tariffs could significantly increase your costs. And there's some indication that the administration might not completely honor those existing free trade commitments when they apply these new tariffs. So that's something to be very aware of. The Outlook also points out that certain industries could be especially hard hit, like technology and electrical equipment, pharmaceuticals and life sciences, transportation, automotive, retail, and even the oil and gas industry. So this really has the potential to affect a wide range of businesses that rely on imported goods.
Okay, so this is something that small business owners who rely on imported materials or finished goods really need to be thinking about now. Are there any strategies that businesses can use to try to lessen the impact of these tariff increases?
Yeah, there are some things you could do. There's some duty mitigation strategies that might be helpful. One is duty drawback, which basically allows you to get a refund of duties that you paid on imported goods that are later exported. So if you're importing components and then using them to manufacture goods that you then export, duty drawback could be an option. Another strategy is first sale for export, which in certain cases can help to lower the value that duties are calculated on. There are also foreign trade zones, which are designated areas where you can delay, reduce, or even eliminate duties on goods that are brought into the zone for specific purposes, like storage or assembly or manufacturing, before they're either re-exported or entered into the U.S. market. And then there are temporary importation bonds, which allow certain goods to enter the U.S. duty-free for a limited amount of time, maybe for things like trade shows or repairs. The Outlook really encourages listeners to explore these options, and I agree, it's definitely worth looking into. It's also really important to do some scenario planning to model out how these proposed tariffs could affect your specific business model and your costs.
That's really great advice. It's all about being proactive and exploring your options. Okay, one last area I want to touch on before we wrap up is potential developments within the IRS itself. It sounds like we could see some changes there as well.
We could. The Outlook mentions a few things to watch. First, there's this potential change in leadership with the nomination of Billy Long to be the new IRS commissioner. And the current chief counsel, Marjorie Rawlinson, is planning to leave. So there could be some shifts in direction there. There's also the possibility of the IRS having its budget cut, potentially through rescissions of some of the funding that was allocated under the Inflation Reduction Act. And if that happens, it could affect their enforcement activities and their ability to implement new programs.
So less funding for the IRS, which could mean less enforcement. What else should small business owners keep in mind about the IRS as we look ahead to 2025?
Well, the fate of the Direct File Initiative is still up in the air. That's the program where the IRS is piloting free direct tax filing. It could be scaled back or even suspended. And then there's the Department of Government Efficiency, or DOGE, which is a presidential advisory commission that's focused on streamlining government operations. And their recommendations could impact the IRS in terms of their workforce, their technology, and the whole tax filing process for both businesses and individuals.
Yeah.
They've even talked about creating a new tax filing app. So, we often focus on the legislative changes that are happening, but changes within the IRS itself can have a big impact on how businesses interact with the tax system.
Yeah, for sure. Okay, we've covered a lot of ground here today. As we wrap up this deep dive into the tax and trade landscape for 2025, what would you say is the most important takeaway for our small business owner listeners?
I think the key takeaway is that we're heading into a period where both tax and trade policy could change pretty dramatically. And that means that small business owners really need to be paying attention and being proactive. There are definitely some uncertainties and some potential challenges ahead, but being informed about those challenges and understanding the different strategies that are available to mitigate the risks is crucial.
Couldn't agree more. So what are some specific steps that our listeners should consider taking right now to get ahead of these potential changes?
First, I'd really recommend taking a good hard look at your current tax situation. Identify those areas that could be affected by the expiring TCJA provisions and all those potential changes that we discussed. If you're a business that imports goods, now is the time to really analyze your supply chain. Model out the potential impact of those tariff increases and start researching those duty mitigation strategies that we talked about. And stay informed. Pay close attention to what's happening in Washington. Track those legislative developments and talk to your tax advisors. They can help you understand how these potential changes might affect your specific business. And for anyone who's operating internationally, even if it's on a small scale, start learning about the implications of those Pillar 2 global tax rules in the countries where you're doing business.
Fantastic advice. So the bottom line is, the landscape of tax planning for your small business in 2025 is probably going to be pretty dynamic. But by staying informed, being proactive, and seeking expert guidance, you can navigate those changes successfully and set your business up for continued success.
Exactly. And as policymakers in Washington grapple with these big decisions about taxes and trade, the real question for you is, what steps can you take now to make your business as resilient and as opportunistic as possible in the years to come?
Food for thought. Thanks so much for joining us today on The Deep Dive.
My pleasure.
We'll see you next time.
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.